everybody. We are running a bit behind, but that's okay. We'll catch up here shortly. Let's talk a little bit about how we see chemicals in the next year and two, right? Again, six key messages. Chemicals have had a tough year, right? Actually, a tough couple of years. 2022 was slow. 2023 was also challenging. But things are getting better, but the outlook continues to be a little mixed. Second, what is helping is that energy and feedstock prices are falling, but chemical margins still continue to be challenged, right? So that's why some of that outlook is mixed. Every year we talk about megatrends that are supporting the chemical industry that continue. Those megatrends continue to be centered in and around energy and materials transition. Some of the discussion that we had with Kelly, for example, was really focused in and around that materials transition. So, those megatrends are supportive of industry growth. But overall, right, I think chemical industry growth is a bit slower than historical cycles. So we are seeing chemical industry capital spending growing, but it's such a much more modest pace. What is also interesting is that the mix of that chemicals capital spending in chemicals is changing. Almost a quarter of that capital spending now is being diverted towards sustainability. And then finally, the broader regulatory landscape is getting more challenging for chemicals here going forward. So that at a high level, as a snapshot, is what we are seeing in chemicals right now. What we have here on the left is a chart that's showing total shareholder returns in the chemical industry in the blue bars, and then we have the global shareholder return for all industrial sectors. So I'm going to start from the far right, actually. So if you take a look at the 15-year return, right, the difference between chemicals and the global return in the market has not been too different. And when we've run versions of this chart in the past here at the ADI forum, actually chemicals would outperform global markets by quite a bit. But what has happened in the last 1 to 3 years has significantly dampened returns for the shareholder industry. And you can see that where just in the past year, there's almost a 15%, 12.5% to 15% shareholder return difference between global markets and the chemical industry. While in the last 3-year time frame, global markets obviously haven't done as well, but there's still almost 100% difference there, right, in returns. So I think broadly speaking, chemicals continue to be tracking global markets today, and we expect them to start surpassing global market returns here. But it's unlikely that we'll see that at least in the next year or two as the market continues to be challenged. And you can see that a little bit in the drivers on the right side, right? You'll see that it's a mixed picture. We almost have 3 drivers that are supportive and positive, and then we have 3 drivers that are somewhat neutral. Inflation's coming down, so that's good because a lot of consumer markets really start spending more, and that's supportive of the chemical industry once inflation starts coming down. Feedstock costs are getting better. We see a lot more certainty and an outlook where we're going to see lower feedstock prices, so that's supportive. And then this new markets, these megatrends that I was talking about, continue to be supportive of growth. GDP growth continues to be modest. We are seeing that picking up, but it continues to be modest. Interest rates, which impact one of the largest segments for the chemical industry, housing and construction, that continues to be a challenging environment. Interest rates are coming down, but still too high to drive additional growth there. And then the broader factors around sustainability and decarbonization, a lot of investment that's going in there, but that's not necessarily supportive of returns. So we have a view of the GDP growth here in terms of what we saw last year. In general, the post-COVID bump that we saw in GDP has kind of run its course. China was somewhat the last to kind of help support that bump in the post-COVID recovery. And going forward, we expect that GDP growth to decline a little bit. So that's obviously not supportive of an industry whose growth is closely linked to that of GDP. If we break it down into some of the key end-use markets, automobile sales, they're finally picking up here in the US. We are expected to sell a little short of 16 million units. This has been a pretty remarkable turnaround, because just a couple of years ago, US had the lowest sales in automobiles in about a decade, right? So this return to the kinds of 15, 16 million units that we typically see for automobile sales in the US is going to be helpful. It needs a lot of polypropylene that's going to be supportive of the kinds of projects that Kelly is working on. If we look at chemical exports, last year U.S. chemical exports fell by almost 7.5%. We expect them to recover, but we are still not quite caught up with the same level of chemical exports that we saw prior to the pandemic, right? So there continues to be more opportunity there for growth. And finally, housing, I talked about this, but housing super challenged right now. High interest rates, challenges with inventory, pricing is a key issue. Collectively, we see housing starts to actually decline this year from a little short of 1.4 million to 1.35 million this year. So that's not going to be helpful. A lot of the materials that the chemical industry makes goes into housing and construction markets, and that's going to be challenging. Inflation is getting better, but still, is a factor that has a pretty big impact. In addition to inflation, we see fairly tight labor markets, and some of the reduction in inflation will offset these tight labor markets, and that will collectively increase global chemical output and production. We expect global chemical production to rise by about 3% or so this year, which is significantly higher than the drop that we saw of about 1% or so last year, at least here in the US. Finally, interest rates. The broad expectation is that interest rates will fall. That will be supportive of greater, consumer spending, as well as it will be supportive of additional growth in the housing space. So both of those things will be supportive for the industry. We also expect, because of lower interest rates, capital spending to rise, and our expectation is that capital spending will rise about 4% or so, and I'll talk about that here in a little bit over the next few years. But in the near term, capital spending growth is going to be a little slow, but we do expect it to grow. What is interesting, as I mentioned this earlier, about a quarter of this capital spending is now being diverted towards sustainability type of projects. So the mix of that capital spending is changing. Now, having said that, right, if you look at the US, there are sufficient demographic drivers that will be supportive of the chemical industry. So, broadly speaking, we expect housing to continue to grow within the US. If you take a broader North American picture, we expect it to grow even more quickly. The amount of spending and expenditure that's going into repair and remodel of existing infrastructure is also rising. And then finally, we have a fairly advantageous demographic mix from a population and age point of view that's essentially in the right range, where we expect additional spending in a lot of markets that will be supportive for the chemical industry. Very quickly, we talked about this at length on Oil and Gas Day here in the US, but we expect natural gas prices to be fairly stable. In fact, the natural gas producers don't like this, but it's going to be below $3. We think through this year, potentially rising a little bit. next year, but in and around $3 even through 2025. So this is broadly speaking helpful to the chemical industry. But a lot of the impact of feedstock prices here in the US have had very little impact, primarily because the US chemical industry has gotten used to low natural gas prices for a long period of time. But it's in Europe and Asia where energy prices and therefore feedstock costs have a big impact. But even in those markets, we finally see some stability returning into these markets. Our forecast for LNG here is roughly $10 to $15 a million BTU over the next few years in Asia and Europe. And actually, if you take European futures, they're actually much lower than that. We think that the European futures are fairly optimistic of the additional LNG capacity that is being built, and that price kind of reflects that. And we do think that should go up a little bit. But broadly speaking, right, the energy, the dramatic increase in energy costs because of the Ukraine invasion, a lot of that stuff, Europe seems to have worked through all of that, and that's not impacting energy prices anymore. So the broad cost competitiveness of the US chemical complex continues to be very attractive. What we have here are steam cracker margins on the left. So if you take product price for ethylene, you add the price for propylene, and then you subtract the price on naphtha from that, right? You essentially are not making any money. It's some sort of a break-even kind of a model right now. But if you have an ethane cracker where you're taking ethane and making ethylene, propylene, and you subtract the price of ethane there, you're ending up with a fairly decent margin. It's not quite the best margin that the industry has seen in the past, but at least you're making some money there. And broadly speaking, we see some changes in the profitability in making olefins, but North America and the Middle East continue to be fairly advantaged. And in general, ethane and NGL-based feedstocks are best positioned. Oil-based feedstocks for ethylene and olefins continue to be, they continue to be out of money. So just looking at feedstock prices here going forward, as I said, we talked about natural gas prices. We expect them to be below $3 this year, potentially next year, but in and around $3. US propane will be a little bit higher than that, primarily because a lot of that is being exported. But US NGL export capacity, as we talked about this on Oil and Gas Day, is now kind of nearing capacity. So you need new export capacity, otherwise you'll continue to see additional pressure on propane prices. We know what the expectation of Brent and crude oil is. Essentially, we expect it to be in the 70s essentially through the next few years. So collectively, Asian propane markets will continue to be fairly attractive from an exports point of view. Essentially, a lot of US NGL exports will continue to end up in Asian markets. So let's talk a little bit about some of the mega trends. Broadly speaking, right, I think what we see is energy transition and materials transition, right? So materials transition is the shift towards sustainability, towards low carbon, low CI, low carbon intensity feedstocks, plastics recycling. All of these are the megatrends that we see. And then broadly speaking, this broad-based push towards energy transition, where electrification, for example, of transportation, the push towards EVs, all of that is going to be supportive of the chemical industry. So if you take a look at lithium-ion battery pack prices, right, that's what we are showing here on the left. Significant decline over the last few years. We expect this decline to continue. It's probably not going to be at the same pace, but a lot of this decline is coming off the back of new chemistries, new formulations, a shift away from lithium-ion to alternative like sodium-ion batteries or lithium-ion LFP batteries, right? So we are seeing a little bit of a shift in these chemistries, and because of that, right, we see the chemical industry being supported by some of these changes. If you take a look at cathode active materials, for example, which is what we are showing here, the size of the market, this is essentially going to grow 25% roughly every year through the end of the decade. And there's significant amount of innovation that's occurring here. There's a lot of optimization of formulations that needs to occur, primarily because a lot of critical minerals and metals that are required for these cathode active materials are not available, or their costs are rising pretty rapidly. So this again means that there's a lot of new investment that needs to flow into this space, and this will be supportive of the chemical industry. Another version of electrification is the shift towards electric vehicles, and the content of polymers, materials, chemicals in electric vehicles is about 2.5 times more than a traditional internal combustion engine based automobile. So that is also another trend that will be supportive of the industry. And then renewable power, if you take a look at polyolefin elastomers, we publish a multi-client study on polyolefin elastomers, plastomers every year. And every year we get requests to update that on an annual basis. Our annual update cycle is a little longer, but we are being asked to update that by clients every year, primarily because we are seeing very rapid growth in that market. So if you take a look at the chart on the right, solar encapsulants that are used for solar panels, PV, the photovoltaic markets are growing very rapidly because of installations in residential markets. We see a lot of capacity that is being added. This is driving a lot of the demand for polyolefin elastomers that are used in these solar encapsulants. Even traditional markets, right? This is a little bit of a busy slide, but we are looking at reactor versus compounded polyolefins here. What we see is there are lots of applications where these products can end up, but it's only a couple of applications where we see rapid growth. And what we are finding is that just because you look at a particular market and say, like, for example, automotive markets are growing quite rapidly, there's a special, there's going to be the same kind of demand growth that you'll expect in a particular type of a product. That doesn't necessarily hold true. You still have to do a lot of voice of customer work to understand whether the broad demand trends kind of hold true for different product formulations in the same material class. So what you see on the right is, for example, the demand for compounded TPOs is much higher in the automotive market in comparison to, say, reactor TPOs, which actually are doing a lot better in residential and roofing markets. So let's talk a little bit about Capex. Broadly speaking, chemical industry Capex prior to the pandemic was growing at a little over 2% every year. We've obviously, following the pandemic, we've seen some growth, but it's been a bit choppy, and especially if you look at the different regions. But we now expect some sort of a stable growth here in Capex at a little over 4% over the next few years. This is still lower than the Capex growth that we saw prior, let's say, through the early part of the 2010s. So I think we expect still additional opportunity for growth here. But again, it's a lot of this Capex is now being diverted into sustainability kinds of projects. There's also some shift in capacity. Obviously, Europe continues to be fairly challenged, primarily because of feedstock issues, especially energy costs, as well as some changes in the supply of feedstock because of reconfiguration of the entire chemical complex in Europe. But we are seeing a lot of plant closures in Europe. Some of the larger companies, BASF as an example, is doing a significant rethink of their asset base in Germany, for example, and is considering ways to kind of reshore or reorganize their asset base in other parts of the world. A lot of this continues to be driven by energy costs. And in addition to energy costs, it is the risk associated with the volatility in energy costs, right? Energy supply into Europe continues to be fairly challenged for the next few years. In comparison, if you look at the Middle Eastern players, we are seeing a lot of investments by Middle Eastern players in a broad range of downstream companies all around the world. If you take ADNOC, for example, they've bought out the rest of their partners' stake in OCI. They've made a bid for Covestro and are interested in acquiring Braskem. They're bringing Borealis and Borouge together. We see similar investments by Aramco, essentially picking up stake in a lot of Chinese crude oil to chemicals plants. What a lot of these Middle Eastern companies are doing is essentially acquiring positions further downstream so that they have an opportunity and an outlet for a lot of their oil and hydrocarbon production. China, which has been a big driver for chemical industry growth, has slowed down quite significantly. In fact, polyethylene margins in China have been pretty bad over the last couple of years. The post-COVID bump or recovery that was expected has gone a lot slower than anticipated. We don't really see that picking up in any substantive fashion. So in addition, there are other broader challenges. The real estate market has slowed, and collectively we expect the Chinese market to be challenged here going forward. If we look at sustainability investments in and around the chemical industry, we've obviously been talking a lot about this at the ADI forum this week. Lots of investments in and around low carbon hydrogen, low carbon ammonia. The methanol ammonia panel here will probably get into this in a little bit more. Plastics recycling is attracting a lot of capital in investments, and we'll talk a little bit more about that in the panel session with Jim, in the keynote with Jim this afternoon, Jim Simon. And then renewable energy, we were talking about this a little bit yesterday. As industrial assets electrify, the demand on renewable power or low carbon intensity power, as one of the panelists yesterday was emphasizing, is going to rise, and it's going to rise by an order of magnitude. When that happens, the cost of that power is no longer going to be the 7 or 8 cents that chemical companies are used to seeing. It's going to be much higher. So that's the reason why companies like Dow are interested in alternative on-site generation technologies, and that's the reason why they're looking at the small modular nuclear reactor for one of their sites here on the US Gulf Coast. And then finally, this push towards bio-based materials. We see quite a bit of investments in and around that space as well. In spite of what is happening in and around the broader dynamics for China, we still expect China to continue to play a fairly significant share in the chemical industry. What we are showing on the left is global chemicals production by region, and you can see that even in a slower economic environment, China is still going to grow at 4%, while the overall chemical production in the US is going to grow at a little over or close to 2.5% or so. We've been spending a lot of time. In fact, a lot of our clients are now increasingly in Asia, especially when it comes to chemicals. And what we are seeing is companies that 5 years ago were fairly small players in very commoditized markets are now essentially giants in those markets. We recently did a very detailed piece of work looking at costs and economics of MDI, methyl diisocyanate, that ends up to make that is used up in a lot of materials that go into buildings and insulation, for example. And Wanhua about 5 years ago was a fairly small player. Today, Wanhua is the largest MDI producer. They are acquiring assets all around the world and are building out an integrated part of the value chain, essentially competing with the likes of Huntsman and BASF pretty aggressively, right? And all of this is coming off the back of essentially advantaged advantaged cost structures in China. But they are also thinking a lot more strategically. So one who recently acquired one of the largest or one of the only technology licensors in the MDI space, essentially having control to the technology that is used to make MDI. So it's very fascinating for us to look at some of these players and see how, as they have grown, they're also changing the way they think about their strategy going forward. What we are seeing in and around energy transition is a significant level of investment across the value chain and across the supply chain, really, right? So if you take electrolyzers, for example, electrolyzers use a lot of components, and the page that I'm showing here kind of shows that there are raw material, the precious metals and the processed materials, their components. And what we are seeing is that 5 years ago, 8 years ago, the investments were focused on gigafactories to assemble electrolyzers. Now the investments are all flowing back. So, we are doing work for companies that make gas diffusion layers to help them understand how true and reliable and certain is hydrogen demand, is demand for these electrolyzers, so that they can go and make $150 million investment in a plant to make more gas diffusion layers. We've done similar work for electrocatalysts, similar work for elastomers, similar work for carbon paper, composite paper that is used in electrolyzers. So it's interesting to see the ecosystem and the supply chain for some of these energy transition markets slowly developing. And these are difficult decisions because some of these are small companies and some of them are private equity backed. So there's a lot of private capital that is hinging on how this energy transition will evolve, and these guys are struggling with making these decisions. And yet most of our clients have made these investments, so they are making $50-100 million investments in building out the supply chain for this broader energy transition. So we are slowly seeing that growing. Finally, there's a lot of regulatory pressure, and that's just intensifying in and around the chemical industry. The Global Plastics Treaty is making progress. If this truly comes into fruition, and of course, there are concerns around to what extent is it going to have sufficient teeth and all of that, but it's calling for an 80% reduction in plastic pollution. What that means is that you need to essentially reduce or substitute plastics by as much as 50%. So there's quite a bit this is one version of the regulatory pressure that we are seeing. If you take a look at Europe, we have done a lot of work in the last year and a half, helping a lot of clients around the world, not just in Europe, but also clients in Asia who are exporting a lot of stuff into Europe, understand what is the ECHA, the European Chemical Agency, doing in terms of regulating the chemical industry. And they are making wholesale changes to a broad range of regulations on chemicals, which will have pretty far-reaching impacts on a lot of end products that use various chemicals. Within the US, we see a lot of regulatory pressure around PFAS. The EPA is changing or has announced plans to change and revise a lot of regulations in a lot of markets. Landfills is an example that we are showing here. Now, what is interesting is that in and around landfills, the states are actually moving faster than the EPA, because the states actually are under a lot more pressure from people in and around landfills and PFAS, that they are actually moving faster, and they think that the EPA process is very slow. So what we are showing here, the states that are not in blue are essentially all the states where we are seeing some kind of activity around regulating PFAS. So that's what we have. Happy to take a couple of questions, and then we can roll into the break.
Good morning. Thanks for covering the chemical segment. I have a question regarding the crude to chemical projects, and specifically about the U.S. Do you see any of the U.S. refiners trying to switch to kind of that way, considering that in the coming decades, the consumption of gasoline is going to go down, or similarly in other parts of the world? Do you see any of that?
Not yet, Anna. We are not seeing any interest in reconfiguring existing refineries in the U.S. to crude to chemicals kind of model. But then U.S. refineries also have a couple of other options that make more sense in the near term, right? One is the conversion to bio-based biofuels or bio-based refineries, right? We are seeing quite a bit of that, especially on the West Coast, where first of all there's quite a bit of regulatory pressure that's making it harder for them to operate as a refinery. But then on the other hand, you have low carbon fuel standards that are incentivizing biofuels quite handsomely. So there's we are seeing that trend on the West Coast or in and around the states that have access into the West Coast market. So that's one trend that we are seeing. On the Gulf Coast, U.S. refiners are exporting a lot of products, almost 1.5 million barrels per day, into Latin American markets. Latin American markets have they actually have sufficient refining capacity, but it's challenged on utilization, and so they import a lot of fuels. And the U.S. Gulf Coast refining complex is the most competitively positioned to supply those markets. So although U.S. fuel demand has somewhat peaked, a lot of the refining complex is essentially exporting. So I think through the next decade, there is probably enough room for U.S. refiners to be competitive because of these trends. But at some point, we will start thinking about I'm sure some of the refineries will start thinking about taking some of their assets and reconfiguring them towards crude to chemicals.
Okay, thank you.
Hello to Uday. Thank you for the presentation. Really appreciate it.
Yeah.
Right over here. Related to that previous question, how do you think of long-term petrochemical feedstock cost competitiveness of ethane versus naphtha? So as gasoline demand declines, do you see that naphtha will become cheaper as a feedstock and more competitive with ethane? Or do you see the opposite, that naphtha will be increasingly expensive, leading to a further advantage for U.S. and Middle East ethane?
I think there'll be some sort of a regional variation to that, Mike, right? I think within North America, we expect naphtha to essentially get cheaper, potentially when distressed, right? We are already doing work for some of your peers on what to do with naphtha in 2035, for example, right? They historically, right, you've used naphtha. Some of it does end up in steam crackers, but the U.S. steam cracking complex has all pretty much migrated towards ethane. The 10% of steam cracking capacity that's there in the U.S. that's still fed by naphtha is at integrated refineries, so they somewhat have captive consumption, right? So essentially the smaller, relatively lower complexity refineries are where you're producing naphtha and you are essentially trying to blend as much as you can into gasoline or isomerize it a little bit and again blend the isomerized higher octane components into gasoline. So I think some of that will continue, but broadly speaking, because of peaking gasoline markets, we expect naphtha in North America to be challenged, right, from a pricing point of view. Globally, we still think that naphtha may be okay because a lot of that still tends, first of all, global gasoline markets continue to grow at some pace, right? And then second, there's a lot of applications for it. You can put it in, a lot of the global steam cracking capacity continues to be naphtha liquids fed. So there's room to kind of dispose it off there. But then broadly speaking, there are other applications on naphtha as well, right? Solvents and some of these other specialized applications which are also growing a lot faster in emerging economies. So there's still some room and opportunity there for naphtha. But yeah, I mean, eventually, what do you do with naphtha and then some of the other gasoline feedstocks is going to get challenging.